This is a video
on the investment plan
on the
Polaris Investing website. Also, we'll be discussing more in depth of the overall valuation method used by the Polaris website, just to further a user's understanding of investment plans. So before we get going, I want to bring up a quote
from Warren Buffett.
You know, a lot of quotes from Warren. I'm not sure when this quote was made. But what's interesting about it is he brings down investing in individual stocks really down to two main concepts of needing to know how to value a company and how to think about stock prices. And really the investment plans is the directly relates to thinking about stock prices. It's one thing to value a stock, but now it's the what to do as it relates to the overall market realities at any given point in time. So what I want to do now is go off to the Polaris website. And here I am at the launch page. And as you go down the launch page, it gives you a brief introduction to the site, things that I assume you're already somewhat familiar with. You visited the site. The valuation itself, like I said, we will go through a little bit of that in this video. But where I really want to focus on is more about knowing when to act. It's knowing, putting together an investment plan and understanding what the investment plan is telling you. So we'll be talking a lot about this horizontal bar chart, and then also how it relates to the price appreciation chart. All right, so I'm going to go ahead and log into the site, and I'm going to immediately go and bring up Walgreens, and just for a brief overview of what this information is here that you're looking at. Based on today's market price of around $65, that I can expect if I were to invest today, practically speaking, about a 14.6% return on my money. The Polaris is calculating that the current valuation of if it was trading at a more fair value, intrinsic value today, would be trading at $87.28 as opposed to the price of $64.78. This is based on a forecast for sales growth, and very important that you as a user feel very comfortable with the setting of this sales growth slider. Every time you bring up a stock, there is a default value, but the default value should be viewed as a starting point, and really requires you as a user to do due diligence and understanding enough about the company that you have a fairly strong opinion on the likely sales growth that the company on average could experience over the next 5 years. So I really caution anybody coming to this site just looking at something like a 14.6% practical return and buying the stock. It really is a starting point, and at minimum should be moving this slider around to a value that you can feel convicted to.
Since originally recording this video, 2 other input sliders have been added for future profit margin and future price earnings multiple. These values used to have to be entered indirectly through the sales growth slider, but now can be entered directly through their own sliders.
The next thing I want to do is go look at the graph here in this horizontal bar chart and make sure we have a clear understanding of how they relate to each other. Start off with the chart itself. Expected price appreciation is taking the practical investment return of 14.6%, and it's just showing you that if you were actually to achieve that, if the market were to actually appreciate it at that rate, this is what it would look like. Well, at any given point in time, here we are today, we're starting right at this point in time, the beginning of the graph. This horizontal bar chart is surrounding that point and saying that if you want to achieve 14.6% rate of return, the market's going to wobble, and unlikely it's going to wobble to this extreme in one day, but it's saying if you were to buy in the $56 to $75 range, which is a broad range, but it's still within the possibility of what the market could wobble around the current price of around $65. Say if you buy within that range and then continue as time evolves, looking at the ranges. The ranges will slide up as the expected price appreciation goes up over time. But if you continue to buy around what the recommended buy range is at any given point, you should be able to make the expected return as the market eventually wobbles into an area that would be a recommended sell area. Ends of this buy range or watch range on both ends, and eventually sell ranges both at the low end and the high end. Well, to look at this a little more in detail, here's another way of looking at it. This purple line right here represents the same line that we're seeing here on the website. The line above here, let's talk about where it's derived from. The red dot is the valuation in 5 years from now. Now, where did that valuation come from? It's taking your sales forecast, applying it to current sales, and it's coming up with a future sales in 5 years. Polaris uses fundamental data about the company and calculates the likely future shares that the company will have in 5 years out. Divides future sales by the future shares to come up with sales per share. Then it takes sales per share and it multiplies by a profit margin. In fact, that profit margin that it uses is down here under the company information. You can see here that the company's average 3.7. It's a fairly stable company, which I'm not going to get into in this video, and therefore Polaris is making the decision that likely the future profit margin will be the same as it is currently now, of 3.7%. So that next step is to multiply the forecasted sales per share by some future profit margin, and that gives you a forecasted earnings per share at this point in time at the red dot. Now, with the earnings per share, you multiply by
Future price earnings multiple.
the Polaris calculates for you, and you end up with a future price at that given point in time 5 years from now. You add in dividends that soon are reinvested through the previous 5 years as time elapses into this 5th year here, and you add all that up and you get an expected valuation in 5 years. Back to the orange line, if you take the red point, and let's go back and look at the website, up here, the market, based on the historical riskiness of the stock, seems to be implying with, or the calculation for that based on beta is about 8%. So back to this graph, if we were now to start discounting back year over year by 8%, we'd back up into a current valuation, $87.28. So that's where current valuation is derived from, is based on this price point here, 5 years. Now, to focus in on that, is as I went through quickly the method that's used to determine that value at that red dot, a logical question would be,
If you know the price earnings multiple 5 years from now, why don't you know the price earnings multiple today at time 0?
why go forward 5 years, have to forecast earnings and forecast future shares and do all this other calculation?
If somehow Polaris had the ability to determine all price earnings multiples, why not just have it determine the price earnings multiple today?
You look at the most recently reported earnings by the company, and you just take earnings times price earnings, and you get what the price or the value of the stock should be today. Well, that's the odd thing about investing in stocks, is that in the current moment, the market, I'll keep using the word wobble, can vary its opinion quite a bit about a stock. And so in the world of investing, it's kind of like an Alice in Wonderland, topsy-turvy world where you would think that maybe more reliable forecasts can come from the current. But in reality, if you go forward in time and kind of leap over all the activity and the unknown and everything going on in the current moment and get out 4 or 5 years from now into the future, you can actually make more rational, more defensible predictions about specifically a
Price earnings multiple.
So let me go into that a little bit more.
For a detailed explanation of what we're ready to cover, you're invited to go watch the video named Multi-Stage Approximation.
I know this is quite an eyeful, and I'm not going to spend a lot of time on it, but just some key points here I think that should be kept in mind is that this is showing that same year over year going all the way out 25 years, and here's the first 5 years. In this graph it's referred to as a disequilibrium period. It's a time when we're in the moment, current moment, and there's a lot of speculation going on by investors, differences of opinion. What the difference of opinion really gets down to is what is the rate of return that investors feel that a company can make on its projects. Because if they can make on average a higher rate of return on its projects, it's going to end up showing up in terms of higher earnings. So in this picture, that difference of opinion is being shown between this R of the investor right here is the anticipated project return that the investor sees for a company, whereas the this R down here, small r, is the project return that the market overall sees, at least projected in this view, that the market, for whatever reason, feels that this company is going to have a much smaller project return on its projects than what the investor is forecasting and hoping for. Well, those project returns internal to the company do end up relating to the investor's opinion about what investment rate of return they can achieve over the foreseeable future versus what the market is perceiving, which is this number here. So this difference in opinion, again, starts off with forecasted project returns, which in Polaris, we don't ask the user to get that granular, but that is something that Polaris makes a decision on by looking at fundamental data and historical data and things like that. So what happens here during the first 5 years that we're looking at here is you're in this very unknown state, but then as you go forward 5 years, not that it changes, you just the next 5 years you're going to have similar kind of, as it becomes, into the present, moves into the present, there's going to be a lot of uncertainty there, and then the next 5 years, and so on. It never ends. But as far as the valuation calculation, if you look at the subsequent 5 years and average them out and then compare the overall valuation to treating each one of these 5-year segments separately and trying to forecast project returns and things like that for each 5-year increment of time, which, by the way, is almost folly in terms of trying to do that so far in advance. But if you make an effort to do that, then you compare the average that you come up with for those subsequent 5 years periods, you'll notice that the valuation are similar. That whether you use an average or whether you use distinct forecasts for each subsequent 5-year period, you get similar valuations. So to keep things more straightforward, the Polaris model just breaks things up into 2 distinct time periods. There's this immediate in front of us time period, the present, over the next 5 years, and then there's this an average performance that we're expecting over the remaining life of the stock. So some people refer to that remaining period as the continuation value period, and then here in the most immediate future we call this the disequilibrium period. Now the question comes up often is, well, where does 5 years come from? It's kind of a Goldilocks period, I think, as most of us think about the future. You think about 1 year out, that's not that far out. You want to make a little bit longer term plans. You go to 2, 3. You get much past 5 years, and it gets to be a little hazy. So that's one reason why 5 years is picked. It just kind of feels right. But the other one is that back testing has shown that as you look at different increments of time together and try to come up with averages for that time period, that 5 years produces very reasonable results. Anytime you go down to 3 years, really you're not giving the company enough time, or just the scenario that you're coming up with enough time to play out.
If you go much beyond 5 years,
Like I've already mentioned, you start getting into kind of a world of fantasy that it's just too far out to put any credibility on that kind of forecasting. So testing has shown that this is a defensible way of looking at the future, just the here and now for the first 5 years, and then an average of subsequent 5 years that represent the overall future. All right, so back to the website. I've already mentioned that the orange line we can bring it all the way back to here to time zero just by using the market expected rate of return based on historical volatility. Well, one main thing I want to point out now is that this gap here between the purple line and the orange line is what some people you may hear called alpha.
if it is zero, then the valuation is aligned with the market.
Then here we are. The blue dot is Walgreens' current price as of today.
That will also be the
Intrinsic value. And if that's the case, then the best that a user can hope for is really a forward price that's kind of like the orange line. It would kind of be out here over time. But since we feel that the Polaris calculates an intrinsic value that's different, we feel like there's an alpha, there's some incremental gain to be made because of mispricing by the market, that the Polaris doesn't expect the price to go out over here that would be parallel with that orange line. It actually expects that it will catch up with the valuation over 5 years. Therefore, that purple line is a steeper incline, but you can see over time the alpha would become less and less. Now, that's a very idealistic view of what could happen in the future. We know we're going to have an extreme amount of wobble at any given time around that purple line. So I really want to focus now on the purple line itself and this concept of wobbling. So let's go out now, let's say it's 4 years from now, and look at where things could be. Well, first of all, you notice is if the price were to be exactly what it is today, you'd be extremely below expectation. Now, again, just to get our bearings.
I'm talking about this horizontal bar chart that is shown vertically here.
That it does change over time. And again, this example I'm giving here is the price were to stay at $65, it'd be way below expectations, and it would have probably signaled
a sell years ago.
Well, what I'm going to do now is let's say the price is maybe $110 today. And so what it's telling you is here you are 4 years out, you're within the buy range. So if you wanted to add to your position from what you maybe initially purchased 4 years ago, this is saying, hey, you're within the range that if you wanted to add, you're on track to make that investment return of 14.6% return. So through the life here in the first 5 years, as long as you're within the buy range, Polaris is forecasting that you will achieve the 4.6% return. Now, will you get that exactly on the 5-year anniversary of you buying the stock? No. It could happen 4.5 years, 4 years. It just all depends on the wobbling that the market does, because as you approach this 5-year anniversary, there's going to be a range associated with around that price as well, and you just have to wait for the market to eventually wobble into the price point that you would be willing to sell and complete your plan. The other way of looking at this horizontal price range, the horizontal bar chart in the website here, it's actually represented as a vertical around that price appreciation purple line, is over here to the right And what's added is this concept of conviction. So let's move the price around and just see how this would make sense. When the price is, and let's bring it back to maybe something a little more current in time. I'm going to go bring it back to like 6 months into the plan. And let's say here we are 6 months into it, and we started out at $65 a share, and the stock is currently trading at $60 a share. So it hasn't exactly stayed on that purple line that we were hoping for. But how would you feel at this point that you're 6 months into it, you were hoping for a price 6 months into it of around 70 some dollars is what you're hoping for, and you're sitting at 60. Well, what this shows over here to the right is that you're likely now, outside the buy area into a wait area, but your conviction is probably, not obviously an exact number, but your conviction is probably dropped off. So it's best to get to the sidelines, meaning don't sell, but just don't put any more into the stock, and wait for the market to make its next move, to see if it moves up, which would increase your conviction, validate your plan. If it continues to move down, though, let's take the example that we now go a year out, and now the price has moved down to maybe $55 a share. It's continued to go down. Well, at that price point, now you're seeing this graph. Your conviction is zero, and the recommendation
Is sell.
But actually, I want to talk more about that. That it not necessarily means just strictly sell. It really means that the stock is not living up to the plan. It's now gotten so far outside the likely ranges that were built into the plan. Polaris is making the recommendation that really you should abandon the plan. Yeah, we could wait it out and hope that maybe it recovers
Eventually.
but it's reached an extreme point early in the life of the plan, 1 year into it, and Polaris would recommend that you
Cut your losses.
So I want to talk about a little bit more about getting out, and really as it relates to changing your plan. Let's say it didn't take a price drop down to 55 to get you thinking about maybe changing the plan. It could be just the opposite. The price is maybe a year from now up here at 70. It's not all that bad, but it's kind of wandering down.
You're just not feeling convicted about your plan anymore.
Well, when I get asked about that, I always say there's two main times to think about changing a plan, and that is when there's been an overall market move. That the price of this stock is down, but the market is way down as well.
Technically, this is referred to as systematic risk.
Or the other reason is the stock itself.
Technically, this is referred to as unsystematic risk.
Something fundamentally has changed with the company. There's been a merger. There's been some lawsuit. There's just been a major change with the company itself that would change the valuation. So let me give you an example. Maybe the price has gotten so low that you want to reassess your plan. Well, let's go with a price point of, let's say it's gotten down to $60 a share. And I'm going to return it back to time zero. And I'm going to add in, back in the valuation line. Practical valuation does take into account the current market price. It weights that sum to say, hey, look, we do a strict calculation of the valuation, but also we use a proprietary method to say, well, what is the current market trying to tell us in terms of valuation as it relates to the current market price. So as our expectation around price has dropped off, it also impacts the valuation. So with a price around $60, and we're going to now start off at $60. You can see here that the valuation has dropped, again, because the market price itself is considered
To some extent in the overall valuation.
Well, now it's saying if this is the current price and you want to reset a plan, it's saying that a go-forward plan now saying you're likely to make 11.4% return going forward. Now you'd have to decide, do I want to adopt the new plan and target 11.4%? Now, if you decide to go forward, what you're doing there is you're giving up on the previous plan. You're giving up on making 14.6%, and that means any money that you invested with historically with the idea of eventually earning 14.6% is all gone to the wayside. Now you're resetting and saying new money that I invest, I expect to make going forward 11.4%. So let's go back to the Polaris website now, and let's look at some existing plans. Well, one plan that I've got is a plan for Walgreens, which is what we've been looking at so far. But I created it about a week ago. Well, a week ago, these bands were slightly different than they are now, because as we move up the expected price appreciation purple line, as was shown, the ranges that the buy range and watch range and sell ranges move as well. So here we are a week into it. They haven't moved much, but the main point is that these are dynamic ranges that should be checked every couple weeks, but realize that they will change daily, not by much, but over weeks, months, definitely a year, they will change much more significantly than that. All right, so one of the last things I want to mention is another way to think about the horizontal bar chart that you see on the website and the price appreciation line is that the price appreciation line is more of a strategic, long-term plan of where you would. It's kind of the center of gravity. It's kind of week to week, month to month, year to year. We expect the market price to be at any given time, knowing full well that it's going to wobble quite a bit around that. And so the wobbling is captured up here in more of a tactical plan. At any given moment, you go look at your current plan. This is the plan as of today at time 0. But again, these ranges will change over time. But you go look at your range and you say, okay, based on where I am, where I expected to be, here's a buy range that I can buy in at, and as long as I do, I'll likely, as the stock price continues to wobble over time, will eventually wobble closer to my purple line here, and it'll be a point where you want to sell to actually achieve your overall investment return. So tactical versus strategic.
Well, anyway, this has been an overview.
How this horizontal bar chart and this price appreciation chart relate to each other. You're invited to go out to the polarisinvesting.com site, take a look around. If you go to the launch page, go all the way to the bottom. There are a couple of free applications you're invited to download and use. Well, that's a wrap. Thanks for watching the video.